Hi there, and welcome to today's free webinar. And the topic is going to help to learn to be a consistent, profitable trader. However, I'm here to introduce the currency markets and what Forex is. So if you're a beginner or you want to learn how to trade the currency markets, then I'm here to give you some information on how to do it. So please note that trading may not be suitable for all investors. The high degree of leverage with foreign exchange, options, futures, including cryptocurrency, day trading stocks can work against you as well as for you. So before deciding to trade, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment. Therefore, you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with trading and seek advice from an independent financial advisor. Um, if you have any doubts, past performance is not necessarily negative of future results. There have been no promises, guarantees, or warranties suggesting that any trading will result in a profit or will not result in a loss. Okay, so today's agenda is I'm going to tell you more about myself, about the program and what you will learn, and simply the introductory to the foreign exchange markets, the terminologies used in Forex. So let's discuss about what is Forex. But before we go to that, my name is Ronaldo. If you haven't met me before, I've been trading now for almost 30 years. I started trading options and then trade stocks and then futures and then Forex. So I've traded all asset classes. I'm a peak performance coach. I'm a certified neurolinguistic programmer practitioner, meaning from a psychological perspective. So I do teach both technical analysis and the psychology of trading. So we have actually classes every day from Monday to Friday. Monday to Thursday simply is we look at potential trades. And then Fridays is mainly what I call a peak performance class, where we discuss the level of performance when it comes to trading. So if you're interested with that, there's a link below, or go through our website at www.esdetrader.com or email me at contact@esdetrader.com. All right, so what is Forex? Forex is short for foreign exchange. This is where the market, you're trading one currency traded for another currency. It is one of the largest markets in the world and the least regulated financial markets in the world. It has a daily turnover of around $7.5 trillion. So when I started, it actually was 1.2. It was the early 2000s, 2003 to be exact. And now it's 7.5 trillion as of 2022. That was the last from a source of the data. And then, mind you, the New York Stock Exchange only trades around $74 billion per day. So there's a big difference between trading the currency markets and trading stocks. I use the foreign exchange markets for teaching because it has a lot of benefits compared to learning how to trade stocks, options, or actually futures. Mind you, my options is mainly the derivative of an asset class like stocks, a currency, like say, and commodity like gold. So it is a derivative out of it, and hence is why trading options is more challenging to learn than any other trading vehicles. So even with trading stocks, if you're in the US, the minimum that you have to have in terms of your capital is at least a minimum of $25,000 if you want to do that. And then, but there's now with different brokers also giving out higher leverage with like 5 to 10. But the disadvantage is simply the market actually closes, and when it opens, there's what we call gaps. But at least with the currency markets, you will see, and I'll share it with you on why the benefits, so why it's good for learning how to trade, basically trading the marketplace. So there's 5 trading centers around the world. The first one is Sydney, Tokyo, London, Frankfurt, and New York. So those are the 5 main trading centers that trade globally. So it's a non-stop when you're actually trading. So what are the benefits and advantages of trading Forex? Number one, it has the ability to profit in both rising and falling markets. Why is it an advantage compared to, say, trading stocks? If you remember 2008, during the financial meltdown, even actually the beginning of the year when Silicon Valley Bank actually failed, sometimes the markets or the stock market will actually close that to the public or to retailers. And hence only institutions would be able to buy and sell. And it minimizes because number one, when there's a lot of fear in the marketplace and no one's actually buying, then the question is who's going to be buying, okay? Or else it's going to fail. And hence, that's why with trading Forex, on the other hand, when there's a lot of liquidity, you can buy and sell at the same time, basically 24 hours, 7 days a week. When I say at the same time, that's what we call arbitraging actually. You can buy or you can sell, which means you can go long or you can go short, okay? So that's one advantage. Number two, it's very liquid. Mind you, 7.2 trillion compared to 25 billion. I believe that's a big difference between the two. It is also highly leveraged, meaning that here in the US, you can play with your money 50 times. So it's a 50-to-1 leverage. Outside of the US, where there's a least regulation when it comes to leveraging, you can get 100-to-1, even 500-to-1. So in other words, if you have $1,000, you can play all the way to $500,000 with your capital. It is traded 24 hours access, 7 days a week, and hence you can manage your risk within the day. So in other words, if you're pretty much unsure because you made a mistake or your intuition is telling you, I don't feel good about this trade, then you can close the trade. If you're trading stocks, for example, once the market is closed, you can't do anything. You have to wait till the next day. And what happens now if it comes down? And say, for argument's sake, you bought Apple at $100 and you put your stop loss at $99.50. But the next day, because of such event that something happened with Apple, the report came in and now it opened at $99. So you're not going to get stopped out at $99.50. You're going to get stopped out at $99. So with Forex, on the other hand, since it moves 24 hours a day, 5 days a week, you can manage that risk at any time. Okay, so that is one of the advantages. Spreads are very minimal. So depending on which broker that you're going to be using, say for example, for me, I use a Wanda. I have the ability to get almost at bank's rates, like it's a wholesale price, and the spreads are very minimal, like 0.2 of a spread, sometimes 0.4 of a spread. So that's one advantage of trading the Forex markets. On the other hand, if you choose to have no commissions, so if I'm having, if I have a minimal spread, then I have to pay commission for it. But if I don't want to pay the commission, then my spread of 0.2 will increase to 1.2. So that's where now the brokers will make money on the actual spread, even though there's no commission costs, but they're smart. I don't think there's no freebies. Brokers will make money on the actual spread itself. Also, you earn interest when you're trading. So depending on which markets or which currency pair that you'll be trading, you'll earn interest if you're basically buying that currency. So that's one advantage. It's open 24 hours per day, 5 days a week. So the Forex markets or the currency markets opens at 5 p.m. on a Sunday and closes at 5 p.m. EST on a Friday. So everything is on Eastern Standard Time or New York time, since New York is the central hub for the financial markets. So there's 5 overlapping trading sessions between 5 p.m. Eastern Standard Time, Sunday evening to 5 p.m. Eastern Standard Time, Friday evening. It starts off in Sydney. So at 5 p.m., which is opens at 5 p.m., it shuts down at 2 a.m. And then Tokyo happens from 7 p.m. to 4 a.m. EST. And then London happens, it opens at 2 a.m. till 12 p.m. Eastern Standard Time. Then New York will open at 8 a.m. to 5 p.m. Eastern Standard Time, and hence 5 to 5. So there's overlapping between exchanges. And then you'll see that when there's an overlapping, it's also a great opportunity because that's where the volatility will also happen. So based on the trading hours, so right there, it starts in Sydney at 5 p.m. and Tokyo will open at 7 p.m. And then London will start at 2 a.m., New York at 8 a.m. So based on the overlapping hours, it's from Sydney and Tokyo exchange, 7 p.m. to 2 a.m., London and Tokyo, 2 a.m. to 4 a.m., New York and London, 8 a.m. to 12 noon. So where it's most volatile or it's most liquid is from 2 a.m. to 1 p.m. Eastern Standard Time. This is where it's most liquid. And then 1 p.m. to 5 p.m. it's more or less active. So I would recommend not to actually trade within that time frame. Then 5 p.m. to 5:15, the spread will increase within that time zone. So 6 p.m. activity starts to pick up due to the Asian market, especially when news reports hit. But special note, is imperative for you to know when it is a good time for you to trade based on your work, time, and trading style. So that's also one advantage of trading the Forex markets when you're, as a beginner, when you're learning. I would never recommend for you to leave your job and then for you to actually learn how to trade. And in my opinion, trading for me is like sports as an athlete. It's like martial arts. So I'm a martial artist. I've been doing Taekwondo now for almost 40 years and Brazilian Jiu-Jitsu for 14 years. So I'm both black belts in both martial arts, in both arts. But at the very beginning, you'll be labeled as, you'll have a white belt, learning basically the foundation of the art. In my opinion, trading is also the same. You're currently a white belt where you're learning the terminologies, you're learning more what Forex is. And then from there, you can't just out of nowhere open up an account and start basically trading. So you're just gambling. Just imagine you going to a dojo and you are challenging the black belt instructor or the master itself. Not good. You're gonna lose. Okay, so same thing in the marketplace. You cannot beat the marketplace. You have to respect the markets, and there's certain rules that you need to abide by when you're trading. And not only the rules of the markets, but also your own set of rules. So there's 7 major currency pairs against the US dollar. One is the euro against the US dollar. Then one is the Japanese yen, the dollar against the Japanese yen, the pound against the US dollar, the Canadian dollar, also known as the loonie, against the Canadian dollar, the Swiss franc against the US dollar, the Australian dollar, known as the Aussie, against the US dollar, and the New Zealand dollar, also known as the Kiwi, against the US dollar. There's 7 major currency pairs against the US dollar. There's actually also another one, which is the Swedish krona, which some people will actually trade, but the majority actually don't trade it, despite the Swedish krona against the US dollar is also one of the major ones. Special note, I highly recommend to focus on these major currency pairs against the US dollar if you choose to learn how to trade the currency markets. Okay, very, very important to know. So let's go through and discuss about understanding currency pairs. So a currency pair is a combination of 2 currencies. We'll take the euro against the US dollar, for example. The first currency, which is the euro, is known as the base currency. And the US dollar, which is the second currency, is known as the quote currency. So you have the base currency, which is the euro, and then you have the quote currency, which is the US dollar. So buying and selling currency pairs, how does it work? Well, all Forex trades involve simultaneous buying of one currency and selling of another currency. So if you buy a currency pair, then you buy the base currency and you're selling the quote currency. So there's also terminology about the bid price and the ask price. What does it mean? Bid price is simply what we call the buy price, and the ask price is simply the selling price. So the bid price, which is the buying price, represents on how much of the quote currency is needed for you to get 1 unit of the base currency. Conversely, when you sell the currency pair, you're selling the base currency and you're receiving the quote currency. So the ask price, which is the sell price for the currency pair, also represents how much you will get in the quote currency for selling 1 unit of the base currency. For example, let's take the euro against the US dollar. Currently, they're selling it for 1.0230, and they're asking in terms of the buying price, the bid price 1.0232. So if you are going to buy the euro US dollar, then you will buy at the quote price at 1.0232 to get 1 unit of the base price. So in other words, euro, which is the base price, so 1 euro equates to 1.0232, which is the quote currency, which is the US dollar. So if you're going to sell the euro against the US dollar, then you will sell it at the base price at 1.0230 to get 1 unit of the quote price. So 1 euro equates to 1.0230. It's very simple. So what are the terminologies used for buying and selling? You'll see traders using the words a lot, like, they will say, I want to go long the euro US dollar. I want to go long Apple. I want to go long the S&P. I want to go long gold. I want to go long copper. So long simply means that you are buying. Okay, so long simply means buying. Shorting simply means selling. Okay, I want to short the euro US dollar. I want to short Apple. I want to short Facebook. Then it means that you want to sell that asset. Okay, so here are the most active currencies, which are the euro US dollar, the pound against the US dollar, the Aussie against the US dollar, dollar yen, euro yen, pound yen, the dollar against the Swiss franc. Let's go through understanding pips. PIP or pip simply means a price interest point. It also means percentage interest point. So when a pip is being calculated, it's actually the same as a tick when you're trading futures or equities. For example, if euro increases from 1.3800 to 1.39000, then this means that it has gone up 100 pips. So with decimals, like the euro US dollar has 4 decimals, and then it has one, what we call the 5th decimal, being known as the pipet. However, it starts off with the first decimal as the ones, second is tenths, third is hundreds, and the fourth is thousands. So let me put in my annotation tool here. So this is your ones. This is the ones, tenths, hundreds, thousands. Okay, so first decimal, second decimal, third decimal, fourth decimal, fifth decimal. And once it goes to the 5th decimal, then you're now dealing with 10 thousandths of basically a pip. So if euro goes from 1.3800 to 1.3801, then it went up 1 pip. If it went from 138.10 from 138.00, then it went up 10 pips. If it went up from 139 from 138, then it went up 100 pips. Okay, so it went from 138.00 to 148.00, then it went up 1,000 pips. Okay. All right, moving forward from there. So that means that euro went up 100 pips. So based on the average pip movement of major currency pairs, let's say the euro against the US dollar, Tokyo is around 76 pips on the average on a daily basis. London session is about 114 pips. New York session is 92. Note that the London session, based on the overlapping, has the highest when it comes to pip counts in terms of the average. Euro is 114. The pound against US dollar is 127 compared to 92.99. US dollar Japanese yen 66 compared to 51.59. So mind you, though, I believe these numbers already have changed. They've increased because of the volatility. More people are trading it. So source right is babypips.com. Best days of the week to trade. You can trade every day if you wish. So if you're more than happy to make like 10, 20 pips a day, yeah, then it's good. Then you can trade from Sunday to Monday. On the other hand, Sometimes I would recommend for you not to trade on Sunday because it's either it's slow or there's some form of the spreads will be wider a little bit, but they will settle at one point in time. But it's also good to just to enjoy your Sunday and then just start from Monday. This is if you want to trade daily from Monday to Friday, of course. The best ones in terms of amount of volatility, amount of pips is Tuesday and Wednesday, Thursday. Tuesday, Wednesday, Thursday is actually the best one. Fridays are also really good, but once it reaches lunchtime, or lunchtime Pacific Standard Time, which is around 3 p.m. Eastern Standard Time, I would recommend actually for you to actually trade anymore. So tips, refrain from trading on Sundays, enjoy your weekend. There's not much activity after 12 p.m. Eastern Standard Time on Fridays. Do not trade after 12 p.m. Manage your time wisely by knowing when to trade. The European session has the highest peak value if you want to day trade, and stick to the major currencies against the US dollar. Okay, if you have any questions, by the way, please feel free to ask questions to the Telegram channel. So there is a free Telegram channel for members that you can ask in terms of questions. But other than that, if you want personal coaching or a group coaching, just contact us at esttrade.com. Let's discuss about leverage. So what is leverage? Leverage is when your invested cash is used to buy or sell foreign currencies that are worth far more than your investment. In other words, leverage gets you more currency than you pay for. For example, now you have retail traders that can receive from 50 to 100 to 1, 400 to 1, even 500 to 1. In the US, since it's regulated, the currency is regulated. The regulation simply means there's certain laws that has been implemented. However, when it comes to price is not regulated because the price is coming from different exchanges across the globe. Okay, so what I mean by that is like, when you're buying gas or petrol, for example, you have different prices when you're buying gas. You might go to Shell and they're selling it for $5.30. You go to BP, all of a sudden they're selling it for $5.50. Then you go to Chevron, they're selling it at $5. So there's a big discrepancy with different petrol or gas stations. Trading the currency market is also the same. You're going through one broker, say Wanda, at Euro US dollar, you say 1.0500. And then if you go to FXCM, for example, 1.0501, and then you're going through, say, for example, Mazari, 1.502. So they have different price points. It also depends as well on which banks they use as a form of their liquidity that will provide the actual price itself. And hence, that's why price, when it comes to the currency market, is not regulated. However, there are certain regulations that regulators implemented with the currency markets, and one of them is the leveraging, depleting from 100 to 1 down to 50 to 1. And this actually started after the 2008 financial meltdown. So leverage can increase profit potential and also can increase, or you can lose everything when you have a higher leverage. That's why if you don't know what you're doing, then please make sure to review this, do an ongoing education, learn how to trade properly. And now basically from this aspect, I hope you're going to learn something from it, and it all depends on where you want to be or you want to go from here. Example of leverage. Say for argument's sake, Tom has $10,000 in a Forex account. Excuse me. If Tom has a 50 to 1 leverage, then his buying power is 500,000. So 10,000 times 50 is 500. So 500 to 1 is his buying power. Now, if Tom has 100 to 1, then his buying power is times 2. It's now 1 million. So rather than him just playing with 10,000, he now can play up to $1 million. So that's basically what leverage is. Let's discuss about margin, because margin is connected with leveraging. And margin can be thought of as a good faith deposit required in maintaining open positions. It is not a fee or a transaction cost. It is simply a portion of your account equity set aside and allocated as a margin deposit. This protects you from losing everything in your account to go negative. That's why you will never go in negativity if you have a margin requirement, because it is important. That's part of the rules and regulations that they implemented. Different brokers give different margins in the US since it is governed by the National Futures Association, or known as the NFA. Major brokers such as Forex.com and Wanda offers 2% margin for, say, Euro US dollar. Please don't quote me on this. Do your homework, double check it, because sometimes they will change the margin requirements depending on how liquid or how volatile the pair is. For example, if you want to buy 100,000 units of the Euro US dollar 1.3800, then you're buying 100,000 euros worth 138,000 US dollars. Okay, so if you don't have any form of leveraging and you want to buy 100,000 units, which is one standard lot, then you need to come up with $138,000. If you're a retailer, no one has $138,000. Only banks or institutions, actually, people who have a lot of money, will be able to provide that if you don't have any form of leveraging. On the other hand, since there is some form of leveraging and there's margin requirements, then the margin is basically, if the margin required is 2%, then $2,760 will be set aside to open up the trade. So you're controlling 100,000 euros for $2,760 rather than $138,000. So this is how they can make it available to retail traders. Actually, in my opinion, that's awesome. Because when you're trading stocks, there's certain brokers that will give you a leverage for 5 to 1, 10 to 1. But imagine you having 50 to 1, then even better. Okay, so here's also a Wanda and Forex.com's margin table. You can actually just click on that, and then it will give you the margin requirements. Actually, let me go through here. Let's have a look. Oh, here we go. Based on Forex, 50 to 1 dollar CAD, 20 to 1. 50 to 1 is a dollar CAD. Let me just go through 50 to 1s. And dollar CAD, but anything with the measure was actually pretty neat. US dollar, Euro, Swedish, Hong Kong's 10 to 1, Euro CAD 50 to 1. So it will give you basically here in terms of the leverage and also the margin requirements for that. Aussie US dollar 33.3 to 1. Interesting. Yeah, so it's gone more expensive. Euro CAD. So they've changed quite a lot right here. Euro dollar Swiss is $1 Swiss used to be 50 to 1, now is 25 to 1. Even Euro US dollar. Sorry, dollar CAD 50 to 1. Anything else? That's 50 to 1 dollar. Percentage. Yeah, that's basically it. Yeah, Euro dollar is 50 to 1. So, okay, so you can go through all this on your own spare time. Okay. Moving forward through there. Okay. Types of accounts. There is what we call a standard lot, a mini lot, a micro lot. A standard lot is simply based on the number of units, 100,000. That is what we call when you want to buy 100,000 units of the Euro US dollar, for example, then you're buying one lot, one standard lot. If there's no leverage, 100,000 equates to 138,000 if the current price of the Euro US dollar is 1.38. Mini lot, on the other hand, you can buy 10,000 units of it. If there's no leveraging, then you're using $13,800 of your own money. Micro is 1,000 units, which equates to 1,380. Okay, but since there's some form of leveraging and margin requirements, then you can control 100,000 units for $2,000 or $2,500 based on that. Pretty neat, actually. So how does leverage margin use with standard, median, micro lots? So if you have a 2% margin with a 50-to-1 leverage, the standard lot, which 100,000 units, rather than you say buying, say 138,000, which you have to take money out of your pocket, but here you can play with $2,000. You can play $200 with a mini. You can play with $20 with micro. So here's now the advantage of using a Forex market as a vehicle to learn trading. Once you are familiarized with the terminologies and you have a little bit more of a knowledge when it comes to trading, when to buy, where to sell, your psychology is all pretty good. I always tell members to always open up a live trading account. And the reason being because the subconscious knows when something is real and what's not real. By you opening up even a $200 or $500 trading account, and you can play with a micro lot. So by you doing so is by showing the level of your consistency, having a small account. Worst case scenario, you will lose all of your $200 or $500, which pretty much it's unlikely that's going to happen because of the margin requirements. But at least it's a part of doing business. That's when you're making a mistake. So for me, there's like an analogy like when you are new into a sport, you like the sport and you want to start to compete, you start off from a club level. Then you're showing consistency, you're winning. Then out of nowhere, you start to play or go to a competition in a state level. You're winning, get gold medal, then you're now representing your state to go to the national level. And then from there, from the national level, you won in terms of your category, then you're representing your own country, and you're now going to the world-class level. My opinion, training is the same. Start small, start from a club level, show consistency, and then increase your capital, go to a state level, consistency, go to a national level, increase your capital, and then you're showing consistency, then go to a world-class level where now you're trading based on the amount of money you want on a day-to-day basis, weekly basis, or monthly basis. Okay, so that is one thing that Forex can give you as a form of an advantage. So here are the advantages and disadvantages when you're trading automatically with a standard lot. So if you have a $10,000 and you $10,000 in your capital and you want to trade normal standard lots, 100,000, say the leverage still the same, 50-to-1, 2% margin. Your total outlay, which is now your one standard, is $2,000. Say for argument's sake, you bought euro dollar 1.3710. 2 days later, the euro dollar went to 1.310 and you sold it. You made 100 pips. Your profit is $1,000. And the reason being because on a normal standard lot, 1 pip equates to $10. Okay, so 1 pip equates to $10 on a normal standard lot. So your return on investment is 50%. Why? Because you outlaid $2,000, you made 1,000. So 1,000 divided by 2,000 is 50% return on investment. Your return on capital, on the other hand, since you made 1,000, is actually 10%. So it's pretty cool when you think of it. After 2 days, you made 10%. And if you're dealing just with the amount of money you laid out, $2,000, you made 50% return on investment. What happens if it drops 100 pips? So the downside of that is basically you have lost 10% of your capital because 1,000 out of 10,000 is 10%. So if you're new to the trading arena, I would not recommend for you to start automatically going gung-ho and trading standard lots. What happens now, if you have a mini account, you're trading mini, but you still have the same $10,000. 1 mini lot is 10,000, leverage still 50-to-1, outlays now is $200. So same scenario, you're buying the euro US dollar. 2 days later, it went 100 pips. So you profited $100 because in a mini lot, every pip that goes up is 1 pip. Every pip that drops as well is 1 pip. So your return investment never changes, still 50% ROI. right? So the downside on this one is that you lost $100, but you only lost 1% of your account. So 10% compared to 1%, that's quite a big difference. So what happens now if you are trading a micro? Same scenario, one micro is 1,000. Okay, so it's still the same. You're only outlaying now your outlay to play is $20 rather than 2,220 bucks. So when the same scenario, you're buying the euro dollar, 2 days later you wait 100 pips. Your profit is $10 because every pip that goes up is 10 cents. Your return on investment is 50%. So that's why the ROI never changes. What happens now when you lose 100 pips? Then you've lost $10. You lost 0.1% of your account. That is one of the major advantages when you're trading the Forex market, is because of the ability to change your standard units from a standard lot, mini lot, or a micro lot. All right, let's discuss about rollovers. What is a rollover? A rollover is a unique feature of the currency market, is that currencies allow you to earn or profit interest in addition to earning from the capital appreciation of the currency. When trading in the spot FX market, it is not a derivative being traded as it is with a futures contract. It is the actual underlying instrument. Accordingly, as each currency has an interest rate associated with it, each position is debited or credited when rolled over. So if the interest rate on the currency you bought is higher than the interest rate of the currency you sold, then you will receive what we call a positive roll, or you will earn a rollover. If the interest rate on the currency you bought is lower than the currency rate on the currency you sold, then you will pay a rollover, or your what we call negative roll. So rollover can add a significant extra cost or profit to your trade. So I know that the US, they didn't change in terms of their federal funds rate. This is the current ones. I might have to double check because I know that Canada, I believe, changed it. So, but nevertheless, these are the current ones based from my last research. But last past few weeks, they've increased interest rates or remained the same. I know for a fact that last Wednesday, the Feds didn't change their interest rates. So here's an example. How do you receive or pay interest? When you buy the dollar against the Swiss franc, for example, you're buying the US dollar and you're selling the Swiss franc to pay for it. So if the US dollar interest rate is 5.5% and the Swiss franc is only 1.75, then you're buying the currency with the highest interest rate, and you will earn a rollover of 3.75% on an annual basis. So if you sell the dollar Swiss, then you're going to sell the currency with a lower interest rate, and you will pay the rollover of 3.75% on an annual basis. Since you are paying the US dollar interest rate in this scenario, then you're earning the Swiss franc interest rate. Okay, gotcha. When is rollover booked? 5 p.m. New York is considered the beginning and end of the Forex trading day. Any positions that are open at 5 p.m. sharp are considered to be held overnight and are subject to rollover. So a position open at 5:01 p.m. is not subject to rollover until the next day, while a position open at 4:59 p.m. is subject to rollover at 5 p.m. Then a credit or debit for each position open at 5 p.m. appears on your account within an hour and is applied directly to your account's balance. So I say, for example, you are long the dollar against the Swiss franc and you want to buy it, then it's best to actually buy it before 5 p.m. So at least you will receive the rollover and it will be in your bank the next day. Anything after 5 p.m., then you're not subject to a rollover. You're going to wait for 24 hours. Okay, so that's one advantage of that. So here's your homework. That's basically it for the introductory to the currency markets, where we discuss about the terminologies, what Forex is. So I would recommend for you to open a Forex account. If you live in the US, I recommend Awanda or Forex.com. I use Awanda. I would recommend for you to watch the history of money. And there's you can just Google it, YouTube it. That's the link of that. review this, review your notes. And there's a really good book called The Creature from Jekyll Island. But it is a really good book. It's pretty thick. If you don't like reading, there's an audiobook of it as well. Just listen to it. And if you want to be in the game of trading, then I would recommend for you to actually read that. Very, very important. There's also another one that I would recommend for you to watch. It's called How the Economy Works by Ray Dalio on YouTube. It's called How Your Economy Works by Ray Dalio on YouTube. Okay, so that is it for me today. I hope you guys enjoyed that. There's your free session, your free class. So if you have any questions, make sure to join our free Telegram channel, and by all means ask questions through there. And also you can email me at contact@estetrader.com. All right, well, enjoy the rest of your day. Take care till next time. Happy trading. Bye now.